Thank you, John, and good morning to all of you. My name is Anu Thomas, and I am the PDC lead for the ICAI Dhabi chapter. Since John and Priyanka were saying multiple comments on time, I am not giving any speech here. So just to welcome the first panelist of the day and the moderator. We have a 45-minute session, which will be moderated by CA Avinash Gupta, partner of Boat APT Global Tax Consultants. And we have 4 panelists for this session. Mr. Girish Chand, Senior Partner, MCA Gulf. Mr. Anurag Chaturvedi, Managing Partner, Andersen UAE. Mr. Rakesh Nair, Director, Corporate Tax, Crowe UAE. Mr. Vijay Mohan, Managing Partner, EVAS International. Welcome all the panelists and moderator to the stage. Thank you.
Good morning, everybody. In the journey of my grandchildren, as John said, so I think, John, you take one picture of us in the panel so that my grandchildren will say that we are there in the panel when we are moderating. But yes, it is an historical moment. Chandrayaan 3 have proved to the world that Indians can do anything. And I'm very happy to see the friendship between India and UAE. I'm happy to announce that UAE is the first country in the world after the successful landing of Chandrayaan 3. So the President of UAE have publicly congratulated India. So this is the kind of friendship that we have with the UAE. And I also congratulate UAE to become part of BRICS. And this BRICS will turn the relationship and export imports and other trade relationship between India and UAE to a next level. And now let's come to our topic of the corporate tax. I think the organizer and the Khalij time have taken due importance to the cabinet decision, ministerial decisions, FTA decisions so much that they have put this first panel discussion on that only. And when I see the law, so many times it was written as decided by the minister or the cabinet. So I believe that this session, what we are going to do is of most use for all of you. So let's discuss this. If you allow me, my panelists, so can I start moving to the topic? So we have a wonderful panel with me, and I hope I will be able to justify my duty before them, and they all are very learned panelists. So I think I should start with the person whom I cannot name because my guru is also of the same name. So Dr. Girish Ojai is my guru and you are also the same. So Girish ji. So I just want to start the first question of the panel with you. So the first question that I have is, so if a UAE company have a shareholder, come manager or maybe director, and that person is staying outside India, and there is only one employee of the company here in India, so whether the poem can be deemed to be in UAE or outside UAE, and what are your thoughts on it?
So, thank you, Avinash ji. It's always a pleasure to be in Abu Dhabi and to be with the ICAI Abu Dhabi chapter. In fact, I've been coming so regularly that, in the tax parlance, I was thinking of taking a dual residency. Okay, so primarily, I think the question which Avinash referred to is basically related to the topic of place of effective management, or to put it colloquially is poem, right? So in the context of this particular question, right, when we talk about the place of effective management, and if we break that question, I think the first part of it, what he was referring to is basically that the company is resident in UAE, okay? Because effectively when you talk about that the company is established here, and if you go back to the residency rules, okay, it basically refers to is that if the company is legally incorporated or registered in UAE. So the first part of it, when we talk about it, the company is resident here. Of course, now we get into the complexity of basically looking at, from where the company is being managed, right? And in the context of the example that is given, so effectively the director, is basically is director and the shareholder, right, Avinash ji?
Yes, sir.
Yeah. So the director and the shareholder is basically outside UAE. Now, when we look at this, obviously, then we need to go back in terms of the, I think the reference point here, if you look at in the law and in the, I think the, basically the detailed guide, right? There is only one reference in terms of the place of effective management, right? Where it basically talks about it from a perspective of the UAE corporate tax law. To say that if, businesses are managed from here, then the place of effective management would be here. Now this would be the opposite scenario, right? So I think when we talk from an UAE corporate tax perspective, the first thing would apply, where we talk about the residence. The second element of it would come from the other jurisdiction or the foreign jurisdiction, for them to say that, no, the place of effective management is in that country, okay? But however, residence is not the only criteria as such. What they refer to is basically saying that where the key management decisions of the company are taken, right? And so I think in this example, what we would also have to evaluate is that what happens, where are the key management decisions of the company being taken, right? So that becomes a thing. If that is not proven, then the OECD guideline talks about the various options of looking at it. And finally, what it says is that if it cannot be resolved, then it is something which is by mutual agreement between the countries that it would be taken. I hope I've done justice.
Thank you, Girishji. If any of the panelists want to add something, so that is theirs. So anything?
Basically, hello. So just to add, basically the decision has to be key managerial and commercial decision. Okay. And that has to be with respect to a broader strategic and policy matters. So if you see the law lexicon, or because managerial and commercial is defined nowhere, you will have to refer to legal dictionary. If you see the dictionary meaning, either you will get managerial decisions, what are managerial decisions, what are commercial decisions. It's on the company to identify which are the key managerial and commercial decisions. It will depend on the fact-to-fact cases. In certain cases, identifying a customer or deciding a pricing policy can be a key managerial and commercial decision. So it all depends on your business. So if you have any situation where the overseas entity is being managed, like your board of directors is based out of UAE, or the shareholders are taking the key managerial and commercial decisions, you have to revisit, you have to see the operations, take housekeeping measures.
So thank you, Rakesh. I think to conclude the important point, what Girishji and Rakesh have told, that we have to see where the key decisions and the commercial decisions of the company is being taken, and merely having an employee on the roll does not mean that the poem is there in UAE. So I move to the second question. I think Anurag, this is for you. So for example, you are expert of transfer pricing, I know. So I go with the transfer pricing, but that is another point where people need many clarity. So there is a word used in the law, connected person. So my question is, who are the connected person covered under this law? And there is one more question that is followed up with a practical. So in an organization or a group, so there are many people who will be designated as a director of the somebody, director accounting, director marketing, but on the license their name is not there. So they are not the manager or the director on the license, but internally in the group they have been called as director. So what do you feel that whether these people, if there is a transaction with them, so remuneration is obviously is there, but there are other transactions or other they are associated with some other companies and there is a transaction, whether the same is also covered under TP, or here the connected person is director means only on the trade license?
So very valid point. See, corporate tax coming in, I'll answer this question in a little bit simplified manner, putting the context of the law. So what is happening now, whenever the corporate tax get implemented in any of the country, there's quite a few important elements that people wanted to understand what is it all about. So first being is that how do we determine the connectivity, right? So connectivity has to be done with respect to three critical elements. One is ownership, control, or kinship, right? So kinship comes in when there's a natural personal relationship that comes in, right? So there are fourth level of kinship. first being is if I say that, a natural person is there, their kids are there, their parents are there. So parent and kids, the first level. The second goes to the grandparent, third one goes to great-grandparent, and fourth one goes to great-great-grandparents and their kids and so forth. That's called kinship. And kinship, how it has been determined, I mean, I was there yesterday and I'll give you a practical scenario about it. So yesterday I was gone to a group where there's a consortium, you can say consortium of the people. They operate in a very different model. So there is no owner actually. There is nobody owner of the group. And they operate in a manner that there are 5 people who, let's say 50 years ago, brought out a capital of 300,000 together. And then it becomes a group of, let's say 50, 60 entities out there. So entities after entities, and this ownership controls continue to be diverted out there. So when I was talking to him yesterday on the corporate tax side of things, and I said, look, you have poem risk here, you have PE risk here, and you have transfer pricing element. He says, look, hang on, kid. It's like 75 years, hang on, kid. But who's the owner of this group? We all brought together 5 people long back. That entity is not in the UAE. That entity is nowhere connected in the UAE. Then I need to drill down and connect with him that who ultimately exercise the control, who ultimately owns that group, and how this entire group functions together. They say we are, as a 5-people board, operate that. So I said, look, you have an entity which is out of UK, established there, but all the decisions making happens from here. So ultimately, who takes the call? I said, board takes a call, or board exercise the control over the directors who take that control. So the first point comes in, the connectivity is defined between the control, ownership and kinship. Right? So they are basically called as connected person. Now coming back to Avinash's point that the person who is there on the license as a director. So generally in the Department of Economy, we say that essentially there is not a requirement to have a board in LLC companies out there. You can have, and ideally you should have as per company's law, but then there is no as such mandate from perspective. Or where the mandate is there, if you have ADGM, you have DIFC, or you have number of free zone entities out there, where there's a requirement to appoint the directors. Now these directors definitely considered to be connected person. But even then, if somebody is not defined as a director on the license, or defined as a key managerial person, how will you determine that? The determination factor is very simple in the transfer pricing and corp tax world, is that whenever the tax auditors comes and they review your books, what they try to analyze is that who in your organization play a significant role. That could be CEO of the company, which not necessarily to be director, a CEO of the company, CFO of the company, right? One of the directors, one of the HR person. So person can be anybody who could be a key managerial person who takes the call in relation to the day-to-day functioning and day-to-day strategy of the business. Those are considered as a key managerial person. So it doesn't matter that whether they're on the license or not. The important factor is that do they exercise right control over the business?
Thank you, Anurag. Anybody who want to add something? Okay. So now I move to Rakesh, my good friend, and being a young guy, I will ask something about accounting. So we all are accountants. So there is one problem that people are asking most of the times to all of us is, so what are the methods of accounting which have been prescribed under the UAE law, and whether for the corporate tax purposes, whether the company has to maintain a separate books of accounts or separate sets of accounts for tax purposes only.
Thank you, Avinash. So under the corporate tax law,
your voice is
under the corporate tax law, if the company has a turnover exceeding AED 50 million, they will have to mandatorily follow IFRS. If the turnover does not exceed 50 million AED, the company can follow IFRS for a small and medium enterprise. And there is an option given to the companies whose turnover does not exceed 3 million, they can follow cash system. Whenever they get the cash, they can account it. And in certain exceptional circumstances, they can apply to the FTA for opting for the cash-based accounting. And your second question on the maintenance of separate books of account, there's no requirement under the law to maintain separate books for tax purpose. But if you're following separate books of account, separate accounting standard like US GAAP for your financial system, then you will have to maintain a separate IFRS books of account for tax purpose. So it depends. If you want to have one set of records for financials and tax purpose, follow IFRS. Or else you will have to mandatorily maintain books of accounts as per IFRS if you are following some other accounting standards.
Yeah.
So there's a little bit of difference here. So what I'll say that if you read the law, and we are reading of the law, it says that Article 40 is there with respect to tax group. So that mandate every single business. First of all, it says that international standard of taxation and international standard of independence within the taxation require each and every entity to maintain separate set of financial statement. Every entity. So irrespective of fact whether you are a tax group or you're not a tax group, every single taxpayer required to maintain separate set of financial statement, which then can be consolidated should you make a tax group. So the requirement is very specific. They say that every member of the tax group or every taxpayer is responsible towards their tax liabilities, penalties and dues. So the requirement is that you should maintain a separate sort of financial statement irrespective of fact whether you are part of tax group or you're not a part of tax group. So it is very essential. You can adopt IFRS, you can adopt US GAAP. Different sort of groups are there within an organization, they can adopt different sort of financials. But it is not recommended that you use one set of tax group US GAAP and one set of things for IFRS. So you should definitely bring out the consistency out there in that relation, I believe.
Vijay ji.
Actually, I will also add to Anurag's points. Actually, we should not only limit to corporate tax law. Rather, we would say that where the company, the legal status of the company, and mainly the LLC companies, or what is the legal status of the company. And there, as per the memorandum, it is very clearly said that separate set of books of accounts to be maintained. So the maintenance of books of accounts will be one of the crucial part in when we are going towards the compliance regulatory world, and maintenance should be on a separate level. That would be more better and for complying the things. And there can be situation where one company can leave a tax group, add to a group. So lot of scenarios can come during the period of time. So maintaining from the beginning a proper set of books of accounts will be one good way of meeting the compliance regulation.
Girish ji.
So I think only just in terms of, because we're talking of books of accounts, right? It might sound simple, but when you talk about large entities, okay, so effectively to possibly say okay, the requirement is IFRS. I think I would put in saying that maybe it is not the books of accounts per se, is more the case of when you kind of draw the financial statements, okay. So the expectation is IFRS. Now, if there are other accounting standards being used as such, maybe that conversion need to be happened, because if we get down to basic entries and for that to be done in a particular fashion, that will be a kind of a very long drawn methodology as such. So maybe it is more to kind of do the adjustments when we talk about it from a accounting standard perspective as such.
Okay, thank you, Girish ji. I can conclude like this. The basic accounting can be same, but the financial statements may be drawn from a tax purposes separately and for non-tax purposes separately. What Rakesh has also said, because there may be somebody is using US GAAP and all. But Anurag, very valid point that ideally they should be similar on IFRS and we should have the same one. Vijay ji, you are the last one who left in the panel, so I cannot assume UAE without the free zone. So I think I should go and ask something about the free zone from you. So a practical situation have come where there is a free zone company. The company have few employees working in a free zone. Some accounting part and other documentation part have been outsourced to another company, an independent company not related to the group, to maybe another free zone, a consultant. The managers of the company is not staying in a free zone, so they are in no free zone, maybe in a mainland, working from there itself. So is there any possibility that this free zone company will be taxed, assuming they satisfy all other conditions of ESR, transfer pricing, and they have not opted for 9%? So that's many companies are asking this question.
The question seems to be interesting. Actually, we are all discussing about lot about qualifying free zone person, how a free zone person becomes a qualifying free zone person. One is that, okay, they should earn qualifying income, and the second one is that they should have maintained proper substance in that free zone. How do you maintain, as per the cabinet decision, when cabinet decision 55 came in, the substance has been very clearly defined, so that core income generating activity should be maintained in that free zone. Also, there should be adequate number of employees, or you can outsource that activity to a related party or to a third party only within that free zone. But if you are outsourcing, there is a proper management by the free zone person should be there. So in your question, there are only few employees are there in the free zone company, and you are outsourcing the activity is possible, but whether that management of that outsourced activity is there or not, that will be a question in consideration. So in that two scenarios, whether adequate number of employees are not there and the management of the outsourced activity also is not there, then there is a possibility that the company may fail on economic substance test, and that qualifying free zone person eligibility may not be there, and if that is not there, it will be taxed at a normal rate of 9%.
Anybody else? Anurag first, if you can.
Okay, so how many of you faced the ESR audit until now? Anybody from the audience? Have you faced ESR audit? Only few.
Two.
So those who face the ESR audit, I'm sure they will understand the meaning of substance. And those who have not faced the audit, they probably will have a difficulty, because outsourcing is a very important aspect. It is covered every single place. But then onus, while you're doing the outsourcing of your certain core income generating activities, when you undertake and do outsource, the onus does not shift from you to somebody. The onus of establishing that core income generating activities undertaking within the respective free zone lies on you, and you need to ensure that the person whom you outsourcing the activity have adequate people. You're keeping a track of that, and the person who's undertaking these activity keeping a track of that he confirms that. And this substance is very critical, friends. I wish that some of you research about you as well, research about this substance factor, because globally, substance is a very important factor, such as, let's say, fund management activities. We do treasury management activity. You can't just have an accountant to undertake a treasury management activity. You need to have a person who is qualified enough to undertake that activity. If you are into the business of loans, let's say you have related party loans and this get managed out there, the person should be capable enough to do that treasury management, cash pooling arrangement management. And if you are doing headquarter activity, the person should be capable enough in your business to undertake that he is supervising the entire headquarter activity, such as that. So this is very important factor for somebody to, avail that exemption of qualifying free zone person.
Thank you, Anurag. Girishji, I'll come back to you. Rakesh want to add?
Just to add one point, if you're outsourcing, it has to be outsourcing within the free zone. It cannot be outside the free zone.
Yeah. Thank you, Rakesh. Girishji, I have a question on participation exemption, because that is also an important part and we have a decision on that. So I'd come with a practical scenario. So there is a company A in UAE, or maybe any person in UAE. So he holds 20% in a BVI company, let's say company B. The company B further holds 50% of company C in Singapore, and A also holds 3% in this Singapore company. So it is like UAE holds 20% in BVI, BVI holds 50% in Singapore, and A also directly holds 3% in the Singapore company. Now Singapore company declares a dividend. So whether company A, who directly does not hold 5% or more, because the law says you should hold 5% or more.
D is also there, right?
So D is a UK company or whatever you say, within the group, let's say. So now D also holds within the group. So but directly holding is only 3%. But indirectly, if I consider, it will be more than 5%. And the Singapore company delivers a dividend or declares a dividend. So now the question is, what many people are asking is whether we are qualified to be a participating exemption in this case, because I am not directly holding 5%, but indirectly I am holding more than 5%.
So I think this question, basically we need to take in two elements of it, okay. One is the element where we talk about the participation exemption, which you rightly answered, that basically need to have a 5% kind of a holding. And what we are talking here is about a, a holding in a foreign entity, right. The second element which is there when you talk about the qualifying group, okay. And when we refer to the qualifying group, what we are basically saying is that the holding in aggregate basically should be more than 75%. Okay, so now when we look at this example, okay, what is happening is that as far as the direct holding is concerned, it is only 3%, so it will not qualify. Then we have to possibly look at the aggregation of the ownership interest. Okay, when we talk of the aggregation, maybe it qualifies, but only element which comes in is that when we talk as a qualifying group, okay, the holding percentage is less than 70%, I presume.
Yeah.
75%.
Correct.
Yeah. So that is where possibly this will not, you'll not be able to take the, kind of dividend income here.
Any other panelists? Yeah. So this is a tricky question. So I may have a different view, because I believe that beneficial owner concept should put in here. And if I am having a beneficial interest of more than 5%, either directly or indirectly, I should qualify. But plain reading of the law, absolutely correct.
The only element there is it talks about a qualifying group when we talk of the aggregation of it.
Yeah, I agree. I think, Anurag, now my question to you, you talked about the tax group. So the question is, what should we do in a tax group at the time of registration, some company in the tax group later on, or we deregister? So how the taxability will work in case of a registration, a new company into the tax group during the year, or maybe deregistration of a company from the tax group during the year? So that's assuming that they are following a calendar year as a tax year or accounting year.
Good point. I think there's a lot of deliberation happening around on the tax group side of things. Very, very important topic. So while we read the law, it has been very carefully drafted. And what it does is basically it allows and require every single business to read these Article 40 very carefully. Not just because you need to understand obviously how the grouping work, but need to understand one fact, that it creates a lot of documentation for you. And not for just only 1 year while you're doing the grouping, and not for the period when you're degrouping out there, but throughout the journey between the organization registers until the time it deregisters as a group. Why? First of all, the ownership condition, which is like 95%. So, I'm sure you all know that conditions, there are 5 conditions with respect to tax grouping should be met, which is laid out in Article 40, which includes like juridical person, same calendar year, same set of books of account, and financials you need to prepare. There's a ownership control, between the parent and subsidiary 95%. So when you group together, it's okay. And during the journey, one of your affiliate or subsidiary wanted to come and join the group. What happens then? First of all, we need to go back and check the condition of Article 40 met together, that they meet all these criteria, they become a part of tax group. But the moment they're becoming a part of existing tax group, there is a lot of documentation required to be maintained. The first thing is that on the date of application for the tax group, how much was the loss or profit this entity is having, and how much of the loss and profit that tax group, which is existing tax group, has. And you add together this entity, again all the participants within the tax group, they are jointly and severally liable for making this tax liabilities adhered to. An important provision in that relation is that they are not jointly, they are individually liable for the withholding tax. Today is 0%, but tomorrow if rate increases 1%, 5%, then they are individually liable, not as a group. So when an entity joins the tax group, you need to maintain the record for if it is loss making, make the loss. And effective date of tax group always becomes beginning of the financial year, unless the federal tax authority decides otherwise. So if you try to add an entity between the year, and let's say you follow calendar year, the effective date of tax will be 1st January, let's say, or following the year when the FTA approves it. That's number one. But let's say one entity leaves the tax group. What happens then? There's a lot of compliances that you require to be done. I'm sure you all have done VAT grouping and degrouping, so you understand the pain of going through it. That the moment you're trying to degroup, you need to again specify all the individual financials, right? So that is what the reason is that Federal Tax Authority says that, and Ministry of Finance says that individual entity need to maintain separate financial statement, because once an entity degroup and it moves out, it will continue with the losses it came along as a part of tax group, which is not utilized during the period when this entity was part of tax group. So let's say an entity comes with 10 million of the losses, and it remain a part of tax group for 3 years. During the 3 year, this 10 million can only be offset should this entity, which is now become a part of tax group, has an income of 10 million. If it has an income, individual income of 8 million, then only 8 million loss can be set off. Remaining 2 million loss can be carried forward till the time this individual standalone entity makes a profit. And if let's say it deregister and it again moves out, then this 2 million of loss can be carried forward along with the part of this entity. So this is where the conditions are. So with respect to the taxability, jointly and severally liable, you need to have a lot of documentation with respect to when you bring an entity into tax group, when you take an entity out of tax group. All these records need to be maintained throughout the period. And if you get a notice of audit during this period, then additional 4 years you need to maintain those records. So tax grouping has to be dealt in corporate tax very, very, very carefully.
Thank you. Anybody else? Thank you. So Anurag, you talked about the audit. So I think the latest decision that we have on the corporate tax is on the power of FTA to be conducting the audit and what the procedure. So Rakesh, can I ask you this question? So how and when the FTA will do the audit, and what are the procedures to be followed for doing the audit?
So basically, what is tax audit? So tax audit is a procedure followed by the tax authority to inspect the commercial records, data, information, and so on, to determine whether the person is fulfilling the obligation under the tax law. If you're not fulfilling, you will have to face the consequences. So when can tax authority or the authority conduct a tax audit? So it can be in normal situation, it can be conducted within a period of 5 years from the end of the taxable period. If there is a tax evasion, the period goes to 15. So till 15, they can conduct 15 years from the period in which the tax evasion has occurred. They can conduct the tax audit. So before conducting a tax audit, the tax authority has to notify the person within 10 business days prior to the tax audit that they are going to conduct the tax audit. And the word is notify, how to notify. So the cabinet decision has clearly stated that the notification can be through post, registered post, business email. It can be through various electronic system. It can be through manual, or it can be decided between the tax authority, the authority and the person. So there are various means by which they can notify the person that they are going to conduct the tax audit. So once the tax audit is conducted, as you have seen in VAT as well, they they notify the person that they need so and so information about the person or of any other person, and the person has to submit those information in the form and means or the location as provided in the notification. So they have to provide, and during the powers are very wide. Like during the conduct of tax audit, they can inspect your premises, the documents in your premises, the assets in your premises. If there is any documents maintained in electronic form, they can verify that as well. They can verify your accounting system. and during the conduct of for functioning of the for proper functioning of the for conduct of the tax audit, they have wide powers. Like they can take copies of your documents, they can make a mark in your original documents that this has been verified. They can seize your documents, they can seize your assets, they can, so whatever they have inspected earlier, they can take that on record. So powers are very wide. And in certain situations, they can, without prior notification, they can come to your office. They can shut down your business for 72 hours with prior approval. They have to take the approval and they can conduct the tax audit. So once the tax audit is done within 10 days, they will have to issue the report. They will issue a report stating the, that will be the result of the tax audit. So the powers are very wide, tax audit.
Anybody else?
Rakesh ji, very well said out there that the powers are very wide. But trust me, friends, FT is very professional, and the auditors are very professional. I mean, in my experience, whenever they come to any premises or any business out there, they give a great opportunity to the business to explain how the business being conducted. They notify pretty well in time and time ahead, and they take the entire process very smoothly. It is not like something which is very scary, it is very difficult, no. The process is very professionally driven, and they provide a lot of cooperation, guidance, and they provide reasonable time to people out there to prepare business. That doesn't mean that they'll give you entire year, but then the process is pretty professional. I must say that. It's a pretty professional process. So nothing to scare, nothing to worry about it. Just ensure you maintain the right documentation. There is no search and seizure so long as you continue to be a good taxpayer, you're adhering to the laws and regulations of the law.
I think I just want to add to what Anurag said. I think we all have experienced VAT for almost 6 years. And if I take a show of hands of how many people have experienced VAT audits as such, right? I'm sure it will be hardly in 5 or 10%. Okay, so effectively, I think the real challenge that we have is about, how do we keep our entire documentation? Because I think we might get into a complacency phase, right? Because what tends to happen is that if you look at it, the ethos here is about self-declarations and self-submissions, okay? And it is in very rare cases or maybe on their risk assessment that they come and, basically do the tax audits as such, right? I maybe, when we talk about corporate tax, maybe that regime can change, but I would still caution that, what we have seen is, and I'm sure you must have seen in your practice also, is that a lot of people get into a complacency mode, right? In terms of what they're talking of, their documentation part of it. And that's something that we kind of say, if you're putting the right processes in place, it doesn't matter whether the audit comes after 1 year or whether it comes after the 4th year or 5th year. Yeah, so that's what I just want to add.
So thank you, Girishji. Thank you, Anurag. I thought that these provisions are copy-pasted from Indian income tax. so Rakesh have just reminded me all the powers of Indian income tax. So I thought, but now Anurag has said nothing to worry in deep. But yes, we have to comply with the law. As we are running out of time, and I have only 9 minutes left to me. So my last question to Vijayji, to you for this panel. There is even one of my friend in the morning have asked me this question, to specifically requested me to cover it relating to the foreign tax credit. So that is also a question where many people are asking these questions. So the situation is, sir, a company which is a UAE company, part of a tax group. So they have earned a 90 million dirham income from outside UAE. And that 90 million is after withholding of 10% in that country, maybe country A, country B. So the income is 100 million, 10 million deducted, 90 million they have got it back to the UAE. And now they are part of a tax group. The net income of the tax group is 0. So there may be losses in other companies in the tax group. So now the aggregate income for the tax group is 0. Can we claim this 10 million deducted outside a UAE as a refund in this country, or how it works?
It's a very complicated question. First of all, to understand that question a bit further, There is no PE for.
There is no PE. So it's a UAE company.
This company in that country.
So UAE company is providing, let's say, fee for technical services to a company in India.
Yeah.
India have deducted 10%, withholding tax comes back 90 billion. Overall group there is a loss.
Okay.
So there is no taxable income.
Yeah, when you look at that transaction, so the taxable person providing any service outside UAE is also taxable in UAE.
Correct.
And now we need to see that whether it makes a PE there. If that PE has been created, then of course, okay, foreign tax credit option will be available. If that foreign tax credit option is not available, then this income is taxed over here. The other tax which we pay in other country, we cannot directly take as a credit in this part of UAE, and we cannot take the refund out of it. That's what I feel out of that. And only thing is that then we have to further look into what is the DTA between the country, that with UAE and with that country A, how this double taxation avoidance agreement is being drafted, and what positions the double taxation can be avoided, and based on that it can be further investigated into. So prima facie it will not be possible, but you can look into the other options of how this is been can be handled.
So any other panelists, if they want to talk about it?
So tax credit will come in a situation where you are paying tax in both the country. A resident so whenever UAE resident is receiving income from other country and there is a withholding tax which is paid in the other country, then you can avail the credit in the UAE, provided you are paying tax on that income in the UAE. If you are forming a tax group, the tax group becomes, they are filing a single return and it's a taxable entity, but obviously in this situation, the tax is zero, so you cannot claim the credit. If there is some tax, then you will have to evaluate the DTAA as well. In certain DTAA, there are methods of tax credit, like there are tax sparing credit, there are underlying tax credit. So you will have to read the provisions of DTAA. Is there a deduction method? So there are methods for tax credit, and tax credit can be availed only if you are paying tax in both the country. If there is no tax, if you are paying tax only in one country, either by withholding, no tax credit can be availed.
I think that provision is valid, and the important condition here is that the rate of tax should be more than 9%. So that's important.
Yeah, I think the catch here, Anurag, is very correctly pointed out by Rakesh ji. So if there is an income and we are paying tax in UAE, then only a credit is available. I cannot claim a refund from a UAE government for a tax paid in a third country. So that's the catch. I agree what Vijay you said about PE and all this. These are all important questions. But normally what is the myth in the taxpayer's mind, that if somebody have deducted my tax 5% like Qatar is doing or Saudi is doing, so they said, okay, I will get a refund here because I don't have a taxable income. So the answer is no. So there has to be an income here, then only I can get a tax credit.
And
so
yeah, so
yeah.
Then many cases, like, there's a provisions of, general anti-abuse and all that stuff is also getting implied. So whenever you're trying to claim exemption or deductions or, foreign tax credit you want to avail, the number of considerations you need to put in picture, right? And obviously foreign tax credit is a concept whereby you can really avail it, but there are a lot of compliances which has to go. And I want to share with you my one good case about it, which can become a practice case. So I'm sure within your group, number of you might be investing your fund outside UAE, right? So when you invest your fund outside UAE, which gets dividend, and that dividend has foreign tax on it, because not every country allows dividend to be without withholding. But how many of you have come across this scenario? Anybody here in the audience come across a scenario that your dividend that you get out of your investment is net of withholding? You got that statement?
Yeah, there are people.
Very few people. Very few people. The reason is that your investments are held through custodians. So basically you go through a fund, that fund has a custodian of the asset, and that custodian basically get an alert that if there's any withholding. And that fund, through the fund you get the net NAV, and you never get to know a chance that whether it was a net of withholding. So many times what you need to go to the fund and ask for the statement through your custodian, and if you establish that you are a UAE tax resident out there, lot of countries will give you that refund in that respective countries. So claiming many times withholding, because of DTAs that we have, residency rules we have, you can avail that benefit. And there's millions of dollars lying with the tax authorities unclaimed in that relation. So I think this is a very important point that you can take out there. If you have investment within your group, you can look through that in different part of the world, and there are possibilities to claim, and there is no time-bound situation out there, like, for business refund, there's a time-bound that in a year you can claim that, after that, no. But in case of your investment, if it is, your tax is withheld, you can go back now, analyze it, ask for the documentation, a little bit of process and effort you need to put together, but you can recover a lot of amount of money in that relation.
So I think, Anurag, very, very fair point what you have mentioned. And with this, I just remember one public information which is there in India. So there is an Abu Dhabi Investment Authority. So that is exempt under a DTA, and the government of India have said, so there are more than 600 crores of withholding tax deposited with the income tax department, which they are not claiming it back. You see? So this, because we have a 20% withholding in India, and the DTA have 10% withholding with UAE, but Abu Dhabi Investment Authority is specifically exempt. But they are not claiming because their managers are not worrying about this particular provisions.
Yeah, people are sometimes not aware about it. It's very, very unique proposition out there. So only people who really divest into it a little bit more, they understand more about it, there's a possibility out there. And corp tax is going smooth. All what Mr. John has said that in the beginning, that we need to be a little bit cautious, plan right, so that you implement right. And once you implement right, you comply right and sleep peacefully.
Yeah. So with this, I think we should end this session, and we are just on time, only 43 seconds left as per the watch given by the Khalid Times. So thank you my panelists, thank you Vijay ji, thank you Girish ji, thank you Anurag bhai, thank you Rakesh ji, and I hope that we would be able to justify this first panel and set the tone for the entire day, and happy learning for the entire day. And with this, thank you very much for the patience. Thank you.